And now today's featured speakers are Woody Benson, class of 1980, and Dr. Kristina Minnick. Considered a business partner and company builder by his CEOs, Woody has spent half of his 35-year tech career on the operational side: Apple Computer, Sony Corporation, Lotus Development, Shiva Corporation, and MCK Communications. And the other half on investing: Lazard Technology Partners, Prism Venture Works, and now Launch Capital. He has been named Mass Telecom CEO of the Year and a top 50 VC by Always On Media. He's been involved with several IPO stories, including as CEO of MCK Communications and as the first investor and now 14-year board member of LogMeIn. He is currently the CEO of Thimble Acquisition Corp, a public SPAC. Woody's also an executive in residence at Bentley, and he hosts a weekly Bloomberg radio show that features discussions on alternative investing with a focus on venture capital. Professor Kristina Minnick's research focuses on empirical corporate finance, particularly corporate governance, executive compensation, director of compensation, and banking. She's also studied mergers and acquisitions and the relationship between cultural values and corporate finance. Her academic interests include corporate finance, mergers and acquisitions, international finance, investments, and banking. In addition to teaching at Johns Hopkins University and the University of Maryland, she was a business analyst at Fidelity Investments, as well as a visiting scholar at the Federal Deposit Insurance Corporation. She's presented at multiple conferences in the US and abroad, including in the Czech Republic, Spain, and the Netherlands, and is published in the Journal of Financial and Quantitative Analysis, Review of Financial Studies, Journal of Business, Financial Management, Journal of Corporate Finance, and Journal of Financial Research. Two amazing experts. Thank you both for joining us. So without further ado, please join me in virtually welcoming Woody and Kristina. Thank you.
Thank you so much for having us today. Well, before we get started with the main event, where we're going to be talking about SPACs with Woody, I wanted to give everyone just a brief overview of what SPACs actually are. This has been something that you can't turn on CNBC without hearing about. And a year ago, most people had never even heard of the word SPAC. So what actually are SPACs? Well, SPAC stands for a special purpose acquisition company, and it's essentially just a shell company that's set up by investors with the purpose of being able to raise money through an IPO to eventually acquire another company. So the SPAC itself has no commercial operations. It makes no products. It doesn't sell anything. In fact, the SPAC's only assets are typically the money that it's raised through the IPO process. So normally, SPACs are created or sponsored by a team of institutional investors, like what Woody does. And these are Wall Street professionals from the world of private equity, venture capital, and hedge funds. And when the SPAC raises money, the people buying into the IPO don't know what the eventual acquisition target is going to be. They're betting on the sponsors and their wealth of knowledge about the industry and using that as the decision to invest in the SPACs. So once the IPO raises capital, and typically SPAC IPOs are priced around $10 a share, that money actually goes into an interest-bearing trust account until the SPAC's founders or the management team find a private company that they think is suitable to go public through an acquisition. Now, SPACs have actually been around for decades, and they often existed as a funding of last resort for companies, for small companies that otherwise would have had trouble being able to raise capital and be able to go through a traditional IPO process. But they've become a lot more prevalent because of the extreme market volatility that was caused in part because of COVID and the pandemic this past year. So what are the benefits of SPACs to the target business? Well, for the targets that are going public through a SPAC, it allows them to avoid market volatility concerns. It gives them potentially more favorable terms and better economics when they're raising money. They're able to maintain the control in the combined company. And it shortens the timelines to have access to capital and to be able to go public. The benefits of SPACs to the IPO investors are primarily the investors are able to focus on opportunities that seem promising, while also they have some downside protection because of the structure of SPACs. And since the SPAC IPO proceeds are invested in government bonds until the merger is closed, the shareholders have the opportunity to exit the SPAC either through liquidation or by selling their shares in the secondary market. So if they get cold feet, they can pull out. And so the SPACs are unlikely to fall below the IPO price until the merger is closed. So essentially, their money is safe, and it's an easier way for them to potentially become involved in the IPO market. Now, the benefit of SPACs to founders is that the SPAC sponsors and founders, they typically get about 20% of the common equity that's been raised in the SPACs. And so if you think about it, it's an investment of approximately 3 to 4% of the IPO proceeds. So for example, if there was 250 million that was raised in the SPAC, the sponsor typically would be able to walk away with approximately $60 million worth of common stock for a $7 million investment in warrants that they made. So the economics are excellent for the founders. Now, how does the process actually work? First, you have that the sponsor company comes together with a purpose of forming a SPAC. And the sponsors typically raise money in two ways, either through private placement in the IPO. The IPO capital is primarily from institutional investors, but there are some retail investors as well. And then the cash that's raised in the IPO is placed in a trust and not released until the SPAC actually finds a target and completes the business combination, or until a specific date. Typically, it's between 18 to 24 months after the initial IPO, if the SPAC doesn't find a business to acquire by then. And at that point, the investors would get their money back. And as I had said before, they're typically priced at $10 per share for the IPO. Now, while the IPO is happening, there's also a concurrent private placement where sponsors purchase warrants for an equal amount to the IPO expenses, plus some specified amount that is held outside the trust account in case there's future expenses. And then the warrant portion of the units intended to compensate the investors for agreeing to have their capital held in the trust until the SPAC consummates the acquisition or until it liquidates. So you hear about PIPE a lot when SPACs are discussed. And what PIPE stands for is Private Investment in Public Equity. And it involves the selling of shares of the public company in a private arrangement with a select investor or a group of investors. And the SPAC can seek a PIPE deal if it needs to raise additional capital to close the merger transaction with the target company. In other words, PIPE is a way of raising additional financing if the price of the target is over the initial funds that the SPAC sponsors raised. And this becomes necessary when the cost of the target exceeds how much money the SPAC raised. So companies have various alternatives when choosing how to go public. Traditionally, you heard about IPOs, initial public offerings, and this is still the preferred choice for many private companies. Think about Airbnb, DoorDash, and even the dating app Bumble. They all made their Wall Street debut in an IPO process. So going through an IPO has several advantages. You get to work with top Wall Street firms, and you are able to appropriately price what your stock is worth through the whole IPO process. And you're also able to find the right buyers. When you go through IPO, you end up getting a lot of analyst coverage, and you get coverage from the investment banks, which creates more transparency. And so it helps reduce volatility when these companies eventually come to market. The downside is that you have to file numerous financial documents with the SEC, and it gives the IPO's prospective investors a lot of time to essentially investigate the company, to pour over all the intimate details about a company before deciding if they want to buy the stock. Sometimes that can be good. Sometimes that can lead to issues that arise. And so the IPO has to be delayed. But the biggest downside with an IPO is that it's costly and that it is a very long process from start to finish. So this is where SPACs come in to help fill that gap. So it used to be that SPAC companies were in that the SPAC IPO process was basically only for companies that couldn't get more traditional financing and get the traditional blessing from Wall Street. And so they had to go through a SPAC. But following the successful debut of companies like Richard Branson's Virgin Galactic and then the gambling giant DraftKings, SPACs have been shot up into the public eye and have become extremely popular. Traditionally, you find, though, that it's smaller companies that perhaps are less seasoned, particularly if they're in younger emerging industries that there's not as much information about how to price that industry, that they decide to go public through a SPAC versus through an IPO. SPACs have fewer regulatory hurdles, and the process is significantly quicker. So versus 12 to 18 months for a traditional IPO, you can generally close a SPAC and have access to the capital between 3 to 6 months from start to finish. Then finally, there's what's called a direct listing. And this is where you bypass the IPO and the SPAC markets and you just list your shares directly on an index, on an exchange. And the benefit of listing directly is that you don't have to pay the fees to bankers and you have more control over how you set your stock price. The downside is you already have to have a strong following in order to make a direct listing successful. And you need to be able to generate interest without having the help of Wall Street or the SPAC experts. An example of this is Roblox. And so there was such a following for Roblox, they didn't need the help from Wall Street to be able to go through the process. So I wanted to give everyone a little bit of background. And now we are going to come to the Q&A with Woody. So give me a second. I'm going to stop sharing my screen. And so Woody, can you tell us a little bit about your involvement with SPACs and how that started?
Sure. So I work for a Pritzker family office called the Pritzker-Vlock family office, and everyone knows the Pritzker name. They were behind Hyatt, Royal Caribbean, and a rental car company. And we have several arms of what we do. One is launch capital, where we do early stage deals. We do direct, and we've done 250, 300 of those. We do direct deals between 10 and 50 million. And last spring, Elon Baum's my partner who runs is the CIO for the family office, were kind of lamenting about the illiquidity in the market for companies that have especially been around 8, 9, 10 years and really don't have an opportunity to go public. And, you know, many, it's not a known fact, but there's decreasing public companies year after year. In fact, if anyone's ever heard of the Wilshire 5000, which used to be a proxy for the number of public companies, there's now like the Wilshire 2200. So much fewer IPOs. And the brand name banks that take companies public, like the ones you mentioned, you know, DoorDash and Bumble, they price that at like 20 or 30 to the company, and then the stock trades to 80 or 90. So the beneficiary there are the Fidelities, Wellingtons of the world, not exactly the companies. And when we saw DraftKings and, you know, go off with a remarkable SPAC, we got involved. We got our family office to sponsor our SPAC, which means they're our economic sponsor, and they put forth a $50 million forward purchase agreement. And with that, we hired Citibank and Credit Suisse to take us public, as you mentioned, Kristina. And we went public, and we were raising $250 million in trust, plus a 50 forward purchase agreement. And we ended up with over $3 billion of demand, really from the top of the hedge fund, mutual fund, family office, and bank world. And, you know, why is that? So the reason why is, you know, number one, a lot of the, you know, big mutual fund companies where clients have enjoyed the great, you know, ride up in their 401ks, you know, if you have dry powder, it's hard to put in the market at an all-time high. There is no such thing as bonds, fixed income, real estate's tough, commodities are tough, and you get no alpha out of private equity or, you know, venture now for 10 years. So these people are actually looking for assets that are available of companies that are, in our case, the ones we look for are companies that are doing $100 million in revenue, that are growing, that can be public, that have muscle memory to be EBITDA. And the quid pro quo is the investors are willing to front a valuation for those companies and give them the capital to achieve their goals. And hopefully in a few years, they have a meaningful stake in a sizable and sustainable company. Believe it or not, they're actually worried about asset allocation, quotients moving forward, and want to have access to things that they don't ordinarily see. And perhaps like the biggest shock to us, and that is the amazing quality of companies that we have talked to that can be public ready, that have, that should be public companies, that have, very important and sustainable businesses.
So what do you think has been the driving force between SPAC's growing popularity?
Well, I think, number one, there's several, appealing thoughts. When the big banks take the companies out, like I said, the majority of the upside goes to the public investors, not the company or the IPO investors. So SPACs provide for a deeper relationship. We talk to companies and I've been involved in several, 3 or 4 IPOs, so I can tell you everything about, an IPO. The bankers, are involved, but not really. But we have a deeper relationship with management. We do our diligence very deep as a growth investor would. We have there's more access, to the company on behalf of the sponsor, so we understand a whole lot more. Can help put together the ever important PIPE investment deck in terms of really understanding the company and its quality. And there's much more of a there's much more collaborative, because in SPACs, the sponsors are tied economically with the company. Sponsors are locked up for a period of time. Sponsors have economic milestones, all these things that provide a partnership. And perhaps most importantly, we work with companies pre-public, going public, post-public, in terms of training them, helping them. We have a broad board of experience. Henry Miller's on the board of AIG, Marblegate Capital. Mike Christensen, ex-Allen Company banker, probably done 350 deals. Meg Fitzgerald, who's brand name in the healthcare world, and a bunch of advisors, each have taken companies public. And we're able to package together all that experience and work very closely with company to bring their, bring the asset to the IPO investors and the PIPE investors. And I think that popularity has evened the playing field. So it's interesting. So far this year, there's been 140 IPOs that have raised $52 billion and 151 SPACs that have raised $51 billion. So, I think this is part of the capital market structure that's here to stay. It's very early in its cycle, and obviously, buoyed by, news headlines or this, people trying to predict it. I think the most important thing to understand, our investors are the top tier, funds. They're investors. I think the important thing is SPACs are for investors. They're not for traders. So I think when people try to read in the Wall Street Journal yesterday, this guy lost money, some doctor, this is not really meant for individual traders or arbitraging the warrants or the stock price. This is really for professional investors who have a long-term bias, who want to have stakes in meaningful companies.
So do you think that COVID was a big driver of this rise in popularity? Had COVID not happened and there wasn't a pandemic, would you have gotten involved in SPACs? Yeah,
that's a great question. I've never really heard that, so I don't know, but it certainly is easy to do all the calls from home, instead of, out zipping around, flying. So maybe that's true. It would be harder for management roadshows, et cetera, hard to do all the work. But I think underneath that, the interesting part is there have been a lot of companies that really benefited by COVID. So now they get a chance to tell their story and to a very interesting market.
Why would a company choose a SPAC versus a direct listing or the traditional IPO market?
So the direct listing is a spicy meatball. Like one went out today, it's down 27%. It's really, like you said, for a brand name company. Coinbase went out on a direct listing. So if you have a huge following, maybe like a consumer following or a crypto following, where people know their name, that's great. People don't choose IPOs. Bankers choose companies for IPOs. If companies chose IPOs, that would be a totally different thing. Look, the IPO is a big business, for the bankers now. I imagine the SPACs, are of course as well. But it's not the management and is not driving that process. The banks are, and they only take out the marquee companies. So companies that are doing $100 million, that are profitable, that are growing, really should be public, and are ignored by the IPO market. Not really a choice. And the bankers, who buy the stock, the way the IPO works is all the bankers buy the stock from the company and then they, resell it. So it's a big economic, risk for them, and fewer and fewer of them, want to do that.
How do you feel about the impact of the quality of new issues on the IPO market with all of the SPACs? They don't have the same length of review. And so is there the possibility that they're not as high quality as companies that have gone through the traditional IPO process?
Well, I no, I don't think so at all. Look, I can only talk about tech and healthcare IT SPACs. I don't know anything about EV SPACs, rocket SPACs, all the, all the kind of crazy speculative stuff. I only know about, real company stuff. And, it is, first of all, we file an IPO. Second, we tell our story. And when the process is we as sponsors engage with the company, we give them an LOI where we kind of agree on terms. That LOI puts us into an exclusive zone with the company where we do a mountainous amount of diligence, way more than bankers do in an IPO, from my experience. We do tech diligence, IP diligence, people diligence, market diligence, all that, simultaneously doing a merger agreement with the company. And then we take all that and we put it into a presentation to not only our investors, but potential PIPE investors. And one of the big differences is SPAC companies are allowed to share their projections with potential investors. IPO companies can't do that. So when companies go public via an IPO, they can only share a potential model. In this case, the companies are allowed to share projections out 1, 2, 3, 4, 5 years, and actually, kind of show potential investors, what their plan is. So I think in terms of, planning and diligence, just as much, if not more, for a SPAC. And then the S4, of course, is reviewed by the SEC, as was our, S1, the IPO. So plenty of regulation and perhaps a little bit more engaged on the actual work.
So what do you look for in your SPAC targets? Is it the company itself? Is it the management team? What's the most important component that makes you want to pursue them as a potential target?
Yeah, that's a great question. So, an early stage venture, all that, it's always team first. And of course, the team's got to pass a high bar. They have to have all the financial systems, totally in place. They have to be audited. They have to have PCAOB. So you have to be public ready. So that's like a checklist type of thing. Second, is this a compelling story? Like I said, a lot of our investors are long-term oriented. So can the company, from its position with a dose of capital, get meaningful share in a very large market opportunity? So we look for big TAMs, companies that can execute, companies that can be public with a funded plan to execute.
So what are some of the key negotiating issues that you found between your SPAC and the target companies?
Well, the key negotiation thing, which is kind of a involved answer, is around valuation. And companies are guided by bankers, and bankers who are more capital market focused versus M&A focused really understand how to position a company and price it to go public, and then hopefully to beat and raise over the first few quarters. But some of the companies caught up in the last few months in the SPAC raise, have demanded high valuations, and inexperienced bankers have given them the high valuation, and then that becomes a real problem in the PIPE marketplace. One of the reasons the SPAC market is at a little bit of a stall right now is the PIPE investors or IPO investors are pushing back on some of these valuations that have been a little crazy. We tell all the companies we deal with, look, we're not your arbitrary valuation. That's not our goal. Our goal is to work with you and your bank and the capital market people that will take you, back out to the investors and the PIPE people to agree on, what that should look like. And I think that makes a lot of sense. But SPACs, as you know, are under a timeline to do a deal, generally within 2 years of doing the deal. And there's a lot of SPACs that are looking for a target, and sometimes they float a high valuation in terms of securing a target, and that just causes reverberations.
So do you think that this frothy market that you're talking about will end up tarnishing the reputation of SPACs, even those that have already existed?
Well, nothing could have been worse with the reputation of SPACs over the last 20 years.
Sure.
It's redeemed itself in the last 10 years, in the last year or so. I think we're going through a learning curve. I think we're going to shakeout. I think there'll be the SPACs have and have nots, people that know how to do SPACs. People hopefully like us have a substantial back office of analysts and people capable of doing deep diligence, experienced operators, not just like looking to consummate a deal. So it's very early in the whole cycle of SPACs, but I think there will be some definite evolution of what that looks like.
So what are some of the legal issues that you've seen that arise during the SPAC process?
Well, the number one, I don't know if it's a legal issue or not. The biggest legal issue is one of conflict of interest, where the SPAC sponsors have an economic stake, either through the funder or the people in the target company. And some of the other investors in that company may feel that it wasn't the best deal. That's the biggest, quote unquote, kind of legal thing that's happening. The SEC, which of course is trying to deal with crypto regulation, the whole GameStop, Reddit, Robinhood, phenomenon, and seeing a resurgence of SPACs, has issued some guidance that's going to do nothing to really change the SPAC market, but it will slow it down a little. And this has to do with the economy of treatment of warrants as a liability versus an asset, which really doesn't mean that much. It just has, it's a higher bar for reporting. It's really nothing different for the company than doing pro forma, type reporting. But I think the SEC probably doesn't like reading about the doctrine in California unless it's buying SPAC ETFs. Like I said, this is a professional investor thing. It's not for traders, and it's not for Robinhood people. And I imagine the SEC will make sure those types don't get hurt. So I wouldn't be shocked if there was an accredited investor clause at some point. But I think over the period of time, it's a fine way for companies to go public. In fact, even though the market has been quote unquote choppy, a lot of companies have gotten out, and most of them are trading out, either down 1 or 2% or up.
So you mentioned accredited investors. Do the investors in SPACs have to be accredited investors right now, or is the market open for anyone to invest in?
Well, pre-going public, our investors are top institutional funds. Our stock is traded. It's got a symbol, THMAU. The money we raise is sitting in a trust, waiting. They're waiting to hear about a deal we do and decide if they're going to go in or not go in. Anyone is free to go and buy or sell, our stock. But you're doing so on like very limited, information, because there's nothing really nothing really to report, but that stuff is available. And there is a period of time from when a deal gets announced to the deal gets closed. The only way investors can get into that deal is actually by buying the SPAC stock, because it takes another 3 months for the deal to close. And then the resulting company will be a public company, and the stock ticker will revert to a ticker by the company's picking.
Outside of their ruling on warrants, do you see the SEC having additional regulation about listings with SPACs or additional oversight?
I'm sure they're looking at it, and I'm sure they, want to make sure, everyone is protected. I have no idea what the SEC thinks.
So, what are some of the risks of investing in SPACs?
So, when you say investing in SPAC, the SPAC after it's public, before it's public?
Both.
Well, there's very little risk, for someone to invest in our IPO, because that's money held in trust, and they can quote unquote redeem and get their money back plus the accrued interest, income. For people to buy the SPAC pre, announcement or that type of thing, it's pretty speculative. So, it's kind of hard to say, why someone would do that. Once the deal is announced and people get to see the underlying target, then it's, you do your diligence, just like anyone else. Is this company, a breakthrough company? It can be, a large company at some period of time. And, just like any investment decision, and all those, materials are publicly available. On the more speculative ones, they're more speculative, the ones that, launching whatever they launch, autonomous cars or, chemicals or rockets. It depends on one's certain appetite.
So what happens if the SPAC fails?
So if the SPAC fails, meaning they can't find a target within 2 years, the money gets returned to the investors, and that's it.
Do you think that there will be an investment opportunity with SPACs in the coming years? That this is going to stay the course and stay as popular?
Yeah, I think it's very important for large scale investors who need to get access to more, companies to keep their asset allocation in tech and healthcare, tech, IT, up to speed. Otherwise all the capital they're appreciated, is just going to sit there with really no place to go. And there really are so many great companies out there. I've been so shocked and pleased by the quality of companies and targets and the ranging of business models and ideas and entrepreneurship. This exists because the bankers haven't broadened the IPO process. And as you say, the IPO process is very expensive, subject, to a lot of regulation. The bankers are out of control and they can pull it at any time. I think this is part of the capital market structure for a very long time to come.
So do you feel like this is the puzzle piece that's been missing with capital raising for companies?
Yeah, I think that's a great way of saying it. Companies that are in the 8th, 9th, 10th year maybe raise capital from growth investors or private equity. Everyone reads about the valuations, but you don't understand the terms that exist underneath it. And sometimes it stymies those companies who want to do a tuck-in acquisition, $50, $60, $100 million acquisition. They don't have the capital to do it on their table from their existing investors. Existing investors, aren't going to up it enough to offset the dilution, and it now frees up these companies to continue to grow.
So recently they've been talking about how the SPAC market is acting essentially as a substitute, a potential replacement for late stage venture capitalists, for private equity companies. What's your take on that?
Yeah, I find that interesting. Look, and it certainly hasn't affected some of these big PE guys. Look at Tiger, for example. They're raising like a $10 billion fund every month. They're very big in growth stage, and they're very big in supporting SPACs. So I don't think it's an either or. I think for companies who feel that they're public ready and can be public ready, we'll go to SPACs. Companies who need that capital to continue to grow to get to that point, perhaps private equity, is the place to go.
Do you have, and you touched on this briefly earlier, but do you have any understanding or insight into why there's been a cooling off of the SPAC market within the past month or so?
Well, cooling off is a relative term because we're talking about a month, and I could say, one thing for me anyway, on being on the Bentley Endowment Committee, which, and we're, been fortunate enough to be top decile. When we look at managers or things, or, we talk in terms of cycles, and cycles are a complete, cycle, sometimes, 5-6 years. So, to say something in a couple 2-3 month period, is a cooling off. It's kind of a funny term because it's nowhere close to a cycle. But that cooling off, I believe, has everything to do with SPACs that were brought to the sponsors with a valuation that the investors couldn't stomach, and they're cutting those valuations. And I think that will create a sense of more realistic process moving forward.
Where are you now in the life cycle of SPACs with your own personal SPAC? The one that you're
well, it's the family office SPAC. Well, I really can't say because we're we have nothing to announce, and when we if and when we do make an announcement, it will be that we have signed the merger agreement, have the PIPE money secured, and we'll be working on filing an S4. And then before the S4 gets filed, the investors into the SPAC get a choice whether to participate or redeem.
So in some of the questions that we had received for you prior to the session, one that kept on being repeated was, what are you most interested in current SPACs? Any that have recently gone public? Is there anything that you think is particularly interesting?
In terms of other SPACs, or?
Yes.
Oh, I really don't pay a lot of attention to be honest. I read the results and we analyze, the results. My colleagues, really understand, have a big feel on that. We've seen a few deals announced that we passed on, which is kind of interesting, for us, in terms of reviewing our process, so to speak. I think the SPACs. Well, I heard this actually from one of the managing director of Bentley, is one of our biggest fund managers, who's done great for us. And we're talking to him about SPACs. He's like, look, guys that just go out and raise a SPAC, because they can, and don't do the work and don't do the diligence, aren't in the market, that don't have a full team, that don't have a board of advisors. Those are the ones they try to avoid. Trying to avoid, people that don't do deep diligence. The beauty of us and being growth and early stage investors, we know how to do deep diligence and engage and have, relationships with the company. And we're told, a lot, we're different than everyone else. So I believe there is kind of a have and have not thing. This is not just like an economic thing. We raise the money, let's see if we can push a deal through. We have $50 million of our own money going into it. So there's a lot of, pride and prejudice that goes into that. So, there are some, brand name SPACs, you mentioned, Branson, there's some big name SPACs, and, whatever, you can read about, ARC and their, SPACs and all that. I think where I get a little, the only thing that makes me kind of suspicious is when PE funds or VC funds raise SPACs, and that I think opens up a little bit of a hornet's nest to, LP, GP interest, conflict of interest, some of, some of that type of thing. And I think now, well, I know now no new SPACs are going out. And I think the only new SPACs that, or the only SPACs that, we'll get funded going forward are, repeat SPAC people.
So you had said that you think that when VC and PE firms get involved in SPACs, that there's something suspicious about that, or that it's, can you elaborate on it?
Well, if you are a VC firm or a PE firm that has a SPAC and you're going to go and target one of your own companies, it creates a conflict of interest, not just on the company side, but if you're an LP you've got to ask yourself, who is funding that SPAC? Is that my carry money, my management fee money? So I don't have a stake, in that battle. We wouldn't sponsor one of our own companies, and we have several companies in our portfolio going through what's called the de-SPAC process, which is going to market after the LOI. I just think some of those things create confusion and conflict.
So, final question for you. As you are involved with Bentley's endowment and you hear about Yale and Harvard and the alternative investments that they have used for their endowments, are SPACs one additional tool that you guys are thinking of adding to the portfolio?
So the first thing I'll say is, Harvard and Yale have a very high exposure to private equity and venture capital. And by working with Terry Carlton and the endowment committee over the last 10 years, we've gotten access to substantial private equity venture funds, Summit, Bain, Third Rock, D1. So we've done a great job in the portfolio about getting access to that. I don't think our charter per se, and I don't know this for sure, but I think, look, we're Bentley, we're conservative. No crypto, no SPACs. I think kind of, straight down the middle. We often say, we do two things. One is asset allocation, and one is manager selection. And given that we meet every quarter, we want to be kind of swayed by some market move and have to do something immediate. We're not market, timers. We're here to build something, substantial, for the university over a long time.
Well, thank you both so much for being here and giving your time. The time really flew by, and I know I certainly learned a lot. Hopefully others did as well. Is there any last remarks that you wish to make, Woody?
Yeah, I think, my thought, it's a very exciting time, that I have to say. You've seen like the 3D printing companies go, the robotic companies go. It's a very exciting time for investors who put their money, with the big funds, knowing that, those people are out doing, a bit of diligence, a lot of work on participating in this. These companies should be public. It's no reason that, they're just privately held for so long. And those, rates just keep increasing. No doubt this market will self-sort from a regulation and accounting and, number of participants. So I think it's something to watch, and I'm not so sure it's for the trader. I think it's for a professional investor.
Thank you. And Kristina, do you have any final words?
I think it's an exciting time, as Woody said, and it's that SPACs offer an opportunity to fix market inefficiencies and provide capital to companies that otherwise wouldn't have access to it.
Great. Well, we'll have to have you both back for SPACs 2.0 maybe next year, see where things go. Things move so rapidly. Like you said, a month is really no time at all. So we'll see how the trends continue. Well, thank you again for joining us this afternoon for our reunion program. Thank you, Woody. Thank you, Kristina. Please stay in touch and please attend more of our virtual events. Have a nice afternoon, everyone.
Thank you, Kristina.